John Higgins, Mortgage One. Happy Monday. So we're past the election here. We got some inflation data last week, which was, for the most part, right on point with what the market overall was expecting. So that was some good news, but still a tug of war going on in the bond market. We see interest rates remaining elevated. I took a look at the chart today, and end of June was kind of where we saw the 10-year break below 4.5%. Right now we're bumping up against that 4.5% ceiling. And if that 4.5% holds, might be a point where maybe the market stabilizes a bit and heads lower. But when we look at the overall tenor of the market, we know that the Fed has another meeting coming up here in December. I think there's a 70 to 80% chance that the Fed is going to cut another 25 basis points. But the bond market seems to be looking past that. They're looking at inflation woes and worries that still persist in the market. We have a new administration coming in with lots of, let's say, new tactics as far as taxing and spending. And the market isn't sure what that all is going to mean for the economy. Right now, the Fed seems fairly confident that they've kind of created this environment for a soft landing where we would not head into a recession. And as we like to say, bad news is good news for interest rates. And the information that we're getting right now in inflation is not great, although it's not bad, but we're not making any progress toward that 2% level as far as how the Fed calculates the inflation rate. And then the economy has been very resilient. The jobs market also quite resilient, creating quite a few jobs, and the economy, nowhere on the horizon at the moment. I think does the bond market see that we're going to slip into a recession. And with all of that, we're at levels on a 10-year treasury and mortgage interest rates that we haven't seen since midsummer. All those gains that we made heading into the fall have kind of dissipated here. So what does that mean for affordability? Nothing good, really. Interest rates on 30-year fixed money at or above 7% right now. And that puts a bigger crunch on our home buyers. And if we're looking at sellers that are kind of what we call rate locked into their home because they don't really want to trade in that maybe 3% 30-year fixed rate that they have currently on their home and trade that up for something over 7%. There's not a whole lot of allure in that proposition. So we'll give you an update next week. This week, not a whole lot of economic data. So we have some Fed speakers out there, but the market is really trying to kind of find where the ceiling on these rates are. If we go above 4.5% on the 10-year treasury, that would be a really bad sign for our mortgage interest rates. So keep the faith that as we move into 2025 here, that interest rates will start to come down. There's lots of reasons that they should go down and could go down, but on the flip side, if inflation pops up or at higher levels than maybe the Fed feels comfortable, they're going to stop any rate cuts and maybe even threaten to raise rates. So have a great week. We'll check in next Monday.